The charts say what they say, and right now they're saying the consolidation patterns are breaking in the bull's favor. This week's video will broaden the scope in terms of the charts that we'll review. Since we'll be moving quickly, if you'd like to read these bullet points, you can pause your video player. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. I'm guessing somewhere along the line you've heard that volume has been low lately. Can the stock market advance on low volume? The answer is yes. Just short-term memory tells us that 2013 we saw lots of tweets and lots of comments in this area here about low volume. This volume here is quite a bit lower than what we had seen previously. Stock market goes up. Horribly low volume, stock market goes up. Extremely low volume, stock market goes up. All things being equal, we'd prefer to have strong volume, but it is not a showstopper and not a reason to ignore bullish charts. This chart looks noisy and complex. It's not if we move through each piece in isolation. We're looking at, in the middle here, risk off bonds relative to stocks. This is what rising fear looks like when the demand for bonds is increasing relative to the demand for stocks. Stocks drop as fear increases. Fear starts to increase, stocks drop. Fear picks up, stocks drop. You can see we were in a consolidation period for a long time. We've now broken out of this box in the favor of stocks over bonds. This is what fear looks like, this slope here. This slope is the same as this slope. This is what the present day looks like. This is what fear looks like. This is what the present slope looks like. Fear and the present day. Until something changes, this chart sides with owning equities over bonds. The concepts here are identical to the previous chart. We're still looking at risk off being short stocks relative to risk on being long stocks. You can see this is an indecisive period here that breaks out of the consolidation pattern in favor of stocks or being long. After you break out of the box, after an observable change, stocks did well. We've got a similar situation. We've been waiting for these consolidation boxes to break one way or another. This looks similar to this, where gains in the stock market followed. Everything we do speaks to probabilities, as this does. Now we're flipping things back to a more standard look. We're looking at IBB, or biotech, a high beta stock or ETF relative to the S&P 500. You can see here, after a consolidation period and a breakout, good things happened. Purpose of the exercise, you can see here when momentum started to pick up. This is momentum for the ratio. After it reached this level here, good things happened in the S&P 500. Oversold territory moves to this level. Oversold territory moves to this level. This is similar to this, where good things happened in the stock market. This is anecdotal evidence and also speaks to probabilities. Same concepts as the biotech chart. Now we're looking at transportation stocks here relative to the S&P 500. Trannies outperformed a little bit again this week and remain with a full-bore bullish look and a positive look to momentum relative to the S&P 500. Same setup here. Now we're looking at higher beta stocks from an ETF perspective relative to the S&P 500. What do we mean by higher beta? All we mean is sectors. This is consumer cyclicals, financial stocks, Healthcare, energy, industrials, and technology are the highest weights here. These are economically sensitive. This is a good sign here. All things being equal, this is bullish. This has moved from a full-bore bearish look back to a full-bore bullish look. This ETF is well diversified, and it owns 100 different stocks. Same concept, industrials versus the S&P 500. If you're a client, you'll notice a lot of these ticker symbols look familiar. XLI still has a full-bore bullish look and outperformed the S&P 500 this week. Regular viewers and clients know this chart. We use momentum. We have been saying for weeks now, when we got to this point, the probability of good things happening in tech stocks would increase. That's where we were last week. This week, we've improved even further. Now we're at a point where the probability of good things happening, probabilities increase or improve once you obtain and stay in overbought level. After that happens, good things happen. After it happens, good things happen. We're back in overbought territory. The longer we stay there, the better. This is our long-term NYSE composite. It still looks bullish. If you know technical analysis, it's impossible to look at this chart and say that this breakout isn't bullish. You can also think of this conceptually as a cup and a handle. I know it's not a pure cup and handle, but conceptually it fits. Higher fear, lower fear, a break above the rim. Typically, that's bullish. We'll close out the video with 6 core charts that are helpful. We'll just quickly go over the basic premise of all this. This is risk on versus risk off stocks versus bonds. The market model uses multiple time frames. This is a monthly chart. The purpose of the exercise is observable bearish changes occurred when the S&P 500 was still at 1544 in 2007. Price dropped below blue, and the slope of blue rolled over. At 1470, an observable shift took place. This is a bearish moving average crossover that we did not see for years. This is an observable change. It came and waved a yellow flag before we moved from 1470 to 666, which was the intraday low on the S&P 500 in March of 2009. Conversely, we have a bullish moving average crossover, observable evidence, blue turns up, price above red, red turns up. All of this takes place in 2009. You may say it'll be different next time. That's a legitimate gripe. It's possible in the next bear market that stocks and bonds are weak. That's why the market model uses multiple risk-on, risk-off ratios, and it also forces bonds to pass mathematical tests. We never blindly invest in anything. The investments or ETFs have to prove it in terms of observable evidence and mathematics. How does this chart look today? Does it look more like this or this? This is the exact same chart as of the close on Friday, June 6th. Here, you can see from a pattern perspective, this is a full-bore bullish look. It looks a lot more like this than it does this. Why have we slowly been increasing our exposure to stocks and holding our other stock positions over the last few weeks? The observable evidence has told us to do so. S&P 500, full-bore bullish look as of the close on June 6th. We showed this bullish breakout in the NASDAQ last week. The NASDAQ was up 1.86% this week and has moved from a full-bore bearish look to a full-bore bullish look. This also looks very good. We have somewhat of a W formation, a bullish breakout, a retest, and now a good-looking chart. A chart like this, and this, they all check bullish boxes in the CCM market model. When something changes, we'll adapt. Right now, these charts look good. Clients and Twitter followers know that we cut our exposure on the conservative side of the portfolio incrementally this week. Why? The observable evidence has shifted back in the favor of stocks. You can see this is a indecisive period here, and at least for now, has a full-bore bullish look in favor of stocks, telling us that I'd rather own stocks over bonds or intermediate-term treasuries. You can also see the look, conceptually, of an inverted head and shoulders pattern. We understand that the neckline's a little shaky. I guess you could draw it this way, but the concepts still apply. Fear, higher fear, lower fear, and a breakout. The Dow broke above this level here on a weekly chart, and you can see this nice clean retest and has a full bore bullish look. One of the laggards in recent weeks has been the credit markets, and even that is starting to show improvement with a bullish moving average crossover this week, and it too has morphed into a full bore bullish look and is beginning to check some bullish boxes in the CCM market model. The market model is performing well for us, but we understand that markets are difficult, and some of you are either new to the markets or frustrated trading your own account. If you'd like to get better and try to improve your probability of success, if you go to our Twitter feed, you'll find numerous links to articles and charts that should be helpful in terms of getting your creative juices flowing in the model building process. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.